The Nasdaq fell almost 5%. The jobs report strong. Good news, bad market. Start with the contradiction and be honest that it's strange. On a normal day, a strong jobs report is good news. More people working, more spending, a healthy economy. And the May report was strong. The economy added around 170,000 jobs, roughly double what economists had penciled in, with unemployment holding in the low 4% range. And yet on the day that report landed, the stock market did the opposite of celebrate. The Nasdaq 100 ETF fell almost 5%, its worst day in months. That is the paradox. How can good economic news hit the most expensive growth stocks so hard? It sounds backwards, and most of the scary headlines never actually answer it. They just point at the red number. There is a real mechanism here, and once you see it, the whole day stops looking random. It explains not just that stocks fell, but which stocks fell hardest, and why the bond market, not the news anchors, did the real moving. So the question isn't whether this labor market snapshot looked resilient. It did. The question is why a healthy economy can be bad news for the most expensive stocks in the market. Here is the chain the market followed. And it's the dominant read of the day, not the only thing that ever moves a market. A strong jobs report tells investors the economy doesn't need help, which means the central bank is in no hurry to cut interest rates and might keep them higher for longer. That expectation doesn't show up first in stocks. It shows up in the bond market. When traders expect higher for longer rates, they sell bonds and bond yields rise. You could see it directly in Friday's session. Long-term treasury bonds fell and sit below their own long-term average, which is just another way of saying yields climbed. Now the key idea. An interest rate is the price of the future. The more of a company's value depends on profits many years away, the more sensitive it is to that price. A stock is worth the profits a company will earn, all added up and discounted back to today by that rate. Raise the rate, and every dollar of future profit is worth less right now. For many of these stocks, the immediate hit was not a factory closing or a product failure. It was the valuation rate applied to their future profits. Those sector-specific worries, including a cautious AI chip outlook from a major chipmaker, were also in the tape that day. What changed most broadly was the rate the market uses to value them. Good news about jobs became higher yields, and higher yields became a lower price for future profits. That is the whole transmission. Economy up, rate expectations up. Now, the evidence that fits the mechanism, and pair each point with what would disprove it. Look at which stocks fell, and by how much. The Dow, full of older cash-generating value-style companies, fell only about 1%. The broad S&P fell more. The Nasdaq, stuffed with high multiple growth, fell more still. And the semiconductors and the most expensive AI names fell the most, around 10% for the chip group, with some hypergrowth names far deeper from their highs. That latter is the tell. The further a company's profits sit in the future, the more a higher discount rate hurts it. Exactly like a long-term bond falls more than a short-term one when rates rise. So this looks less like blind panic and more like a precise repricing. Falsifier. If the selling were really indiscriminate fear, the Dow and defensive stocks would have fallen just as hard. They didn't, which supports the rate and duration read. Second, the company's trailing reported earnings didn't change that day. Falsifier. That holds only until forward estimates move. If estimates start falling too, this stops being just a rate story. Third, a repricing to a new rate level can be a one-time reset, not necessarily a spiral. Falsifier. That's only true if yields settle. If they keep climbing, the reset keeps going. The pattern fits a discount rate shock. Whether it stays just that is the next question. Now, the part the calm red can underplay. The difference between a one-day repricing and a regime change. A mechanical reset to a new rate level is survivable. The multiple steps down once, then stabilizes when yields settle. The danger is when one hot report becomes a trend. When yields don't just jump and stop, but keep climbing because inflation reaccelerates, and the central bank has to stay restrictive far longer than anyone planned. In that world, it isn't a single step down. It's a sustained re-rating of every long-duration multiple in the market. And the most expensive AI stories take it the hardest, again and again. There was a cross-asset warning sign inside that day's tape. Gold fell almost 4%, and bonds fell too. So the usual bond or gold haven cushion did not show up cleanly, which can point to investors raising cash rather than calmly rotating. And here is the trap in the duration logic that made the bull case. The same math that says the AI names fell for a clean mechanical reason also says they have the most to lose if rates keep rising. Because the longest duration assets are punished the longest. We watched exactly that play out through 2022, when a year of climbing yields turned a repricing into a grind that re-rated the most expensive tech lower, month after month. So the bear case here is precise. The risk is not that that day was a one-time reset. It is that the regime case gains weight. If this proves to be the first signal of a higher for longer path, with the longest duration AI names the most sensitive if inflation keeps the rate rising. And a rising rate hitting stocks is one of the oldest patterns there is. In 1994, the Federal Reserve raised rates faster than markets expected, and bonds had one of their worst years on record, the so-called bond massacre. Yet the economy held, and stocks recovered within a couple of years. That one was a scare, not a regime. In 2013, a mere hint that the Fed would slow its bond buying sparked the taper tantrum. Yields spiked, the most rate-sensitive assets sold off hard, and then it passed. But 2022 was the other ending. Yields rose all year as inflation ran hot and the Fed kept tightening. And that wasn't a one-day repricing, it was a sustained regime that re-rated the entire market lower, with the long-duration tech names falling the most, exactly as the duration logic predicts. Late 2018 told a smaller version of the same story, when the Fed was racing into a slowdown. Same opening move every time. A strong number or a hawkish signal. Yields up, the expensive stuff down first. What separated the scares from the regimes was never that first jump in yields. It was whether the rate rise stopped and settled, or kept going because inflation forced it to. So which is it? A one-day repricing, or the first day of a higher-for-longer regime? Back to where we opened. A strong jobs report, and the most expensive stocks falling the hardest, because a higher discount rate shrinks the value of far-off profits. Read honestly, that day's move is explained, but its future isn't decided. It starts with one variable above all, yields, and the second test is whether earnings expectations hold. So watch the bond market, not the stock headlines. The three highest signal items. Does the rise in yields stop and settle, or keep climbing? Does the next inflation print confirm higher for longer, or undercut it? And do company earnings hold while the multiple resets, or do estimates start falling too? The rest is on screen. Whether the central bank's tone shifts, and whether the damage stays a multiple story or becomes an earnings story. Yields settling with earnings intact is what the repricing case depends on. Yields grinding higher on hot inflation is what the regime case depends on. One last thing, and it's not advice, it's arithmetic. When the discount rate moves, the longest duration assets move the most, in both directions. So the same AI names that fell hardest that day are the ones most leveraged to whichever way yields go next. The next rate and inflation prints tell you which case the data is backing, and the bond market reports it first. One last thing. The hard numbers here, the index and sector moves, the bond and gold direction, the drawdowns, come from market data providers and reflect one fast-moving session. So they will have moved by the time you watch this. The framework for reading them, good news, higher yields, lower value for future profits, is a standard valuation mechanism explained with AI assistance, and it can be applied wrongly. Check the current yields and the latest inflation data yourself, and treat nothing here as a prediction or a recommendation.